please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Fourth quarter GDP numbers came in at 7.7%, higher than the CNBC TV18 poll of 7.4%. Growth for FY18 as a whole came in at 6.7%, largely in line with the CNBC TV18 polls. But this number, however, is the lowest annual growth rate in the NDA regime, or under Prime Minister Modi's regime. GVA growth, gross value added, which is plus taxes minus subsidies to get to GDP. GVA growth for the fourth quarter came in at 7.6%, a very good number. But remember, this is on a low post-demonetization base of 6% in the Jan-March of 2017. Robust growth in sectors such as agriculture, manufacturing and construction were the biggest contributors to the overall growth in the Jan-March quarter. Also, importantly, at long last, capital expenditure, or gross fixed capital expenditure, appears to have picked up both in FY18 as a whole and, more importantly, in the fourth quarter of FY18, indicating that if capital investment has started, we have better prospects of growth going forward. Are we? That's the question we are asking, and we are joined by an elite panel of economists: Sajid Chinoy of JP Morgan, Soumyakanti Ghosh, Group Chief Economic Advisor at SBI, and Shubhda Rao, Chief Economist, Yes Bank. Gentlemen and lady, thank you very much for joining us in this chat. Well, let me start with you, Sajid. Are the numbers impressive, 7.7, and more importantly, the quarterly numbers, 7.6% GDP?
Lata, they're impressive on the headline level, but there are some important caveats here. I would characterize this as being strong domestic demand, government-led growth. If you look at core GVA, which is to net out agriculture and net out government spending, you actually find a softening of growth there. Growth goes from 7.4% to 7.2%, despite there being a very favorable base of just 4% in the corresponding quarter the previous year. So the private sector really hasn't, I would say, momentum has actually slowed in this particular quarter when you look at core GVA, despite the fact that you had a favorable base effect. What's very impressive, as you hinted, is government spending, that you've seen 13% growth on a base of 16%. And my suspicion is a lot of the investment that you spoke about is actually being done, state, center and CPSEs as well. So this is a big government push, which is pushing up growth. One final point I'll make is that, again, in a kind of baffling manner, net exports continue to disappoint. Export growth in the last quarter softened, import growth is strong. That deducted a full 1.5 percentage points from GDP growth. So in a relatively strong global environment, India is not reaping those benefits. Okay,
well, that's important. The government final consumption expenditure is very high, as is gross fixed capital formation. Soumyakanti, do we have enough information to say that the capital formation is largely government-led and not private-led?
No, I would broadly tend to agree with what Sajid said. It is mostly government-led, and another important factor that perhaps a pickup of an investment revival is that if you actually look into the household data, I mean, there has been some pickup in the household investment in the last 3 quarters thanks to the affordable push by the government. So I think that is one of the factors which is pushing up the overall investment number. So apart from the government, that is one positive thing which is coming out from this data.
Okay. Well, I'll come to you with more nuances, but let me get first thoughts from Shubhda Rao as well. Shubhda, will you worry too much about the fact that private final consumption expenditure was only 6.6% for FY18? We thought there was this big private consumption engine, company after company, from all the FMCGs to the tractor makers, the NBFCs. They all tell us that consumption is good. But why is it just 6.6%, lower than quarter ago?
Yeah, absolutely. I think over the last 2 or 3 quarters, we have seen consistently, particularly last 2 quarters, we have seen the data that the capital formation is growth is exceeding the private final consumption expenditure. Quite clearly, consumption still relatively on weaker footing. which is a little bit counterintuitive, because if you look at the pay commission payouts and its manifestation on the numbers as far as the consumer-facing industries are concerned, they seem to be performing better. But overall, if you look at farmers' income having a decline in the earlier parts, with MSPs, that will come good. Clearly, I think we have seen a laggard in terms of the private final consumption expenditure, which we believe going forward should start showing up in the next 2 or 3 quarters.
Okay. Well, now let me come to the export issue that Sajid has raised. Export growth in the 4th quarter is only 3.6%. That's a rather poor performance. I'm comparing 4th quarter to 4th quarter, but I think on a full year basis, it is slightly better at 5.6%. So just to repeat, export growth, just 5.6% year on year, and 4th quarter on 4th quarter is only 3.6%. Shubhda, is that a worry at a time when actually global growth is picking up?
Absolutely. I think, the lagging of export growth has been more of a domestic factor than the global factor. Global growth has been improving quarter over quarter. However, I think our key issue was the export refunds, which were lagging behind, which I believe now have begun to pick up. Exporters seem to suggest that now the refunds have come back to them, and that should hopefully start showing up in, better exports. Weaker currency should also help in supporting exports. But, carrying forward what Sajid was also saying, that net exports have cut back growth in the fiscal year gone by almost 1.5%, and that's true. Going forward, I think that is something that we would continue to watch out for, because net exports may only be widening that gap, because imports are going to get worse off. Our current account estimate for the ongoing fiscal year is, a much deeper one at 2.6 is what we believe at. So with domestic growth showing a pickup and oil import bill, threatening to rise at a much quicker pace, we would see net exports being a drag. On the positive side, I think the capex recovery, yes, definitely the onus has been on the government side to do the heavy lifting, as is getting reflected. But our sense is now it has gradually begun to spill over in the private sector. Capacity utilizations are getting better. If you look at investment GDP ratio is getting better. It's a 7-quarter high. ICORs are improving. Productivity gains are showing up. So overall, I think while the heavy lifting was done by the government over the last year, the spillover is beginning to show up. Order books are showing a fair, smart recovery over the last 2 quarters, particularly the quarter gone by. And therefore, we are hopeful of an investment-led support as well from the private sector to contribute to growth in the current fiscal year.
Okay, but guys, after listening to you all, have gotten a little skeptical. I started off thinking 7.7% GDP 4th quarter looks so damn good. But my panel of economists have put 2 or 3 worries on the table. One, private consumption is not doing all that well, which we thought was doing well. Exports have been quite a disappointment, and particularly in the 4th quarter, which means, we have yet to see proof of export kicking up. And third, I thought that the, GFCF, the gross fixed capital formation, is a damn good number at 14.9% for the 4th quarter. But my experts tell me that this is largely government-led. So it's looking a little limp at the end of it. Sajid, now let's get to the internals of this, the output side of GDP. If you look at agri, manufacturing, services, what are the key takeaways?
I think the key takeaways again is this is largely led by agriculture and government spending. As I mentioned, agri has been very strong government spending this quarter. On the GVA side, or the production side, you take away agriculture, you take away government spending, GDP growth or GVA growth, core GVA growth as we call it, actually slows in the quarter from 7.4 to 7.2. And this is off a base of 4% in the last Jan to March quarter. So it tells me private sector momentum softened a little bit, and that these very impressive headline numbers are really being held up by government, by central government, state government, and public sector enterprises. There's another point, I think, the demarcation between industry and services, very impressive industrial growth, as you pointed out. Construction very strong, manufacturing very strong. Services has kind of disappointed. I think the key thing, Lata, going forward is how much of this is replicable going forward. How much of this is a leading indicator going forward. I think this is a good number. We should celebrate it, but let's be a little bit careful. In the last 3 months, a few things have happened. Oil prices are near 75, and domestic financial conditions have tightened a lot, both because of domestic factors and global factors. So when we project growth next year, if one's going to say oil is going to be at 75, which is an adverse terms of trade shock compared to last year, financial conditions are tightening, and you've got a deleveraging underway, I will still forecast an acceleration in growth, but I'll be careful about how much that is. I think 6.7% this year will go to 7 or 7.1. We need to be careful about that going to 7.5, unless India starts participating more fully in the global economic recovery, which we haven't seen the last year.
Oh yes, now it's sounding a little difficult to project. I was under the impression that a very good capital formation number indicates things will start firing up in the next 12 months in terms of more jobs and consumption. Well, we will come to your future projections in just a minute, but let me get Soumya's thoughts as well on the breakup: agriculture, manufacturing, services, trade, public administration. What are the key takeaways? As Sajid says, do you also worry that if you take away agriculture and take away government, what's remained is actually slower growth compared to Q4 last year?
No, actually, what Sajid said is correct. As growth rate has slowed down if you take out the agriculture and the other part from 7.4% to 7.2%. However, before I start discussing 1 minute, I'll just point out about the export growth rate which we are talking about.
Sure.
In fact, there are now reports in domain that the global growth, there is a new term which has been coined, is an asynchronous global growth. So I'm not sure whether the global growth will be as solid as in the next couple of months, because there are reports that the Chinese exports and surveys are showing, the PMI surveys, the Chinese exports are actually slowing down for whatever reasons, because of the trade wars or others. But I think that's a worrying sign, because if the global exports start to slow down and Indian exports, given the way they are now stuck in some sort of GST refunds and other things, I think it will be a difficult thing on the part of these net exports not to act as a drag on the overall GDP number. Now, having said that, in terms of the breakdown, if you ask me, I think the manufacturing sector growth rate was largely expected, because if you look into the corporate GVA number, that came in at quite around 15 to 16%, which is a very high correlation with the overall manufacturing GVA. But on service sector, I think I'm a little bit disappointed, because I was expecting that the trade, hotels, transport, communication sector should log in a growth rate of at least close to 10%, but that has not happened. And it seems that the strong growth in the transport sector, because if you look into all indicators of transport sector, the civil aviation, the cargo handle, the commercial vehicle sale, which jumped by 74%. I think most probably the trade sector and the communication sector has done quite badly, because communication sector, there is also an issue of there is also a communication sector issue of basically the sector is not doing well.
Yes.
Regarding the agricultural sector, the second advanced estimates of food grain production are better, and I believe that the non-agricultural component, the horticultural sector, has also done possibly well, so as to give us such an impressive number. So overall, a good set of numbers, but some point of caution are obviously there.
Okay. The areas of worry are: one, that private consumption is not kicking. Yes, capital formation has increased smartly by 14.9%, but that has largely come from government, not private sector. And third, they're all worried about exports not doing terribly well. The next step is to ask, how much can you extrapolate for FY19? Well, first up, Sajid, what would you say? You already expressed worries about FY19. What would be your growth number? Will you change it because of what you saw in the just released GDP numbers?
So I don't want to be alarmist. I think first we should celebrate the fact that in the last 3 quarters, the Indian economy has been recovering very nicely.
Yes.
Despite not getting any tailwinds from the global economy, it's been headwinds. And I think this is largely kind of payback to the drags from demonetization and GST. And I think the recovery will continue in the next year for many of the reasons you mentioned. I just think we have to be careful about estimating the quantum of the acceleration next year.
Sure.
Our own sense is 6.7% ends up closer to 7.1 or 7.2. That would still be a healthy acceleration. And I think the hope is here that the net drag from net exports will fade, that as some of these supply chain issues are resolved and the real exchange rate, which has appreciated 20% over the last 3 years, it's depreciated 6% in the last 3 months. Hopefully that will help exports and curb imports. But as I mentioned, there are some very real headwinds here.
Okay.
You know, our estimate is the fall in oil prices boosted GDP growth by 150 basis points 3 years ago. Now, if oil were to be at 75, that will hurt GDP growth. Monetary conditions have tightened around the world and in India. I think that continues. And you're still in the midst of a meaningful bank deleveraging process. So we don't expect bank credit growth to industry to pick up in a hurry. So I think for all those reasons, I think if we get to between 7 and 7.2, we'd be doing very well next year.
Okay. Well, that sounds too well argued for anyone to disagree. And I would vouch for, of course, bank credit getting tighter. Sajid, I want to Soumya, I want to introduce one more element. You know, the MSP numbers. We've got some bits and pieces by way of leaks from the Niti Aayog on pulses. We still don't have the exact MSP numbers. You know, do you think that will change the arithmetic in any fashion, improve consumption? What are your projections for FY19 GDP?
See, in terms of the FY19 GDP numbers, we are actually projecting a GVA growth of 7.2% and a GDP growth of around 7.4%, but with a little bit of an upside risk. The number could actually tally between 7.3 to 7.4%. Now, having said that, I think that the MSP actually is a very interesting question which you asked. In fact, if you look into the market prices which is prevailing in the states, I mean the Mandi and the MSP make a comparison of MSP across crops, and if you just try to juxtapose the total number, if, for example, if you are supposed to give a price compensation scheme to the farmers, the number, if you take all the crops, the number is actually coming in excess of 25,000 crores, close to 30,000 crores. And the situation on the ground in terms of the agricultural prices is really a little bit in distress, and I am of the belief that this will put pressure on the MSP support program, and this will actually put some amount of pressure on the fiscal deficit, because whatever arithmetic if you look into, this number is unlikely to be lower than 20,000 crores as on first estimates.
Okay, that's very important. You have a crude number and you have an MSP number which Soumya says is looking inflationary because it can increase the fiscal deficit. Shubhda, that directly brings me to the policy question. If this is the combination, and growth, according to Soumya, though Sajid disagrees, is going to be towards 7.3, 7.4%, is it incumbent that we are going to see policy rate hikes as early as June 6th?
Yeah, I think our own estimate earlier, mind you, we were before the crude oil price surge, we were at a 7.5 forecast for the current fiscal year. But having seen the sustainability of these prices, even if we look at a $75 to a barrel, the India crude basket, we could see the growth shaving off by about 20 basis points. Mind you, the sensitivity to oil prices is much less on growth and more on current account deficit and inflation. For CAD, it could be about 50 basis points. For inflation, it could be around 38 basis points. For growth, it is just 15 basis points. So I don't think there's going to be a very steep correction in terms of growth. 20 basis points is what we are looking at. And basis this, oil, if it remains at 75, you know, inflation could be around 4.9% is what we are looking at. I think there are two factors that we need to look at. The timing of rate hike. While most of us believe that a rate hike is in the offing, whether it is in August or whether it is going to be, you know, brought in earlier in June, there are equal number of reasons, but we still have a base case of a rate hike in August. June, the reasons could be because, you know, the peer pressure would be there. Indonesia has already raised rates twice in 3 weeks. We have seen Philippines raise rates. India could also look at it, but mind you, Indonesia raised it also to defend their currency. We don't have a tailspin as far as our currency is concerned. The second is, you know, the monetary Monetary Policy Committee members, two of them have already indicated that by June they would be voting towards a tightening. And if you look at the core inflation trajectory, core, it's close to 6%. So these factors could, bring in a chance of a rate hike in June. But why we believe RBI could and should wait in August is you have monsoon outlook, you have effect meeting. Sorry.
I have to interrupt you. I have to interrupt you.
So these 2 or 3 factors.
I have to interrupt you only because we've got very little time and I want wrapping up comments. Since you are making a case for a rate hike, would your GDP number therefore get affected? You said you're going with a 7.4% GDP. Won't that get affected if there is 1 or even 2 rate hikes? Shubhda?
We have looked at sensitivity of rate hikes, and having that, we are bringing it down to 7.3.
7.3. Okay, Soumya, how many rate hikes are you factoring in, and what is your final GDP estimate, therefore, for current year?
As of now, we are not looking into rate hikes in June because we believe that there are too many moving parts in the debate. So we need to look into all the factors very dispassionately before we take a call on rate hike or whatever may be. So as of now, we are sticking to a 7.3% GDP number for the current fiscal.
Okay. And Sajid, I thought your GDP number was 7.1.
Yeah, we're between 7 and 7.2, and this presumes 1 to 2 rate hikes, so 25 to 50 basis points in the fiscal year.
Okay, but would it be that you're going to get a much better growth in the current quarter, the April-June quarter, because this was still affected by a very bad base of 5.7% GDP a year ago? So would it be that you'll have a better growth in the first 2 quarters and it slows later, Sajid?
Purely for technical reasons, you're exactly right. That April, May, June, you had even weaker growth last year, so you've got a very favorable base, number one. Number two, remember, with the budget being moved to Feb 1st, the government front loads a lot of its spending in the April, May, June quarter. So for both those reasons, I think this year you'll find that the first half looks better on a year-on-year basis, and the second half kind of slows. Okay. But a lot will depend on how monetary conditions evolve through the year as well.
Okay. Well, last thoughts from you. Soumya, what would be the quarterly spread of the GDP? You're also working with 7.3 like Shubhda. What's the quarterly flow?
See, the first quarter next year should be very good because we are working with the lowest base. So I will not be surprised if you get to a number closer to 8% in first quarter. So first up would be better, but I am not so sure about the third and the fourth quarter numbers next year. So a strong first quarter, within second quarter, the number perhaps closer to the first quarter, but a second half, which is a little weaker than the first half.
Okay. Shubhda, final question to you. Would you also agree we manage 8% in the first half and probably slip down to 6 point something in the second half?
Yeah. Yeah, I think absolutely, because we also need to be minding of the ability of the government to, do the heavy lifting for growth support in the second half, which perhaps may not have as many degrees of freedom.
All right. Well, sorry, Soumya, Sajid and Shubhda, thank you very much for joining in this conversation. We have to wrap it up. The important point is, whatever the number, 7.1 or 7.3, we clearly are going to trough out from that 6.7 growth, which FY18 gave us. Looks like the GST woes will be behind us, but we are not very sure that we will be able to export and take advantage of global growth. But the more important point that I might leave you with is that we'll have a very strong, probably 8% GDP growth number for the current and next quarter. But in the electioneering quarter, what we may get is the third and the third quarter numbers, which may look like sub-7, and that may not sit very well for a government that is trying to win back its work permit into the government. Leave you with that thought. Thank you very much for joining me in this special discussion on the state of the economy.